Good evening, everyone. My name is Yogesh, and once again, welcome to this webinar on managing risk and emotions in trading. Uh, we have done a lot of seminars before 2020 where we used to meet people, connect with them, interact a lot. Due to the pandemic, last entire 1 year, we have not been able to organize any kind of group session. So we have done plenty of webinars, and the purpose of all these sessions have been just one, and that is raising awareness about the risk in the financial markets, discuss about the opportunities, investment opportunities in a year, discussing also about what sectors can be beneficial. And this is something which has been always a very interactive session. I see a lot of names right now who have participated in these sessions before, who have attended these sessions before, and most welcome to all of them. And I see a lot of new names as well. So perhaps this is the first time. All of you, most of you are new, and this is very good because now this proves that a lot of you are taking interest in not only knowing about the stock market or what's going on, or also about investment opportunities. And that's really important because now the time is different. Everybody wants to take the authority, and everybody wants to understand where their money is being invested or where to invest the money. And this is something which is called financial literacy, financial independence. So this is something really good. Rather than independence, I would like to say gaining more and more financial literacy, because everybody needs to take their own investment decision. Now, the objective of this webinar is very simple, to make you independent, but also not to leave you alone. So there is a sufficient amount of consultation which is provided by Century Financial, and a lot of training and support and assistance. I see now a lot of users have joined already. I would request you, you have a chat option next to your system, and you can use it to ask questions. Meanwhile, if you can hear me clearly and see the presentation which I have, please give me a yes or a okay so I can proceed further and start my session, because there can be a lot of network congestion we have seen all these weeks. Please, if you can hear me properly, just give me a yes or a okay using your chat option. Great, perfect. Thank you so much, everyone. Now I'm going to begin this session, and before I start this, because by the end, or if somebody has to leave in between, I don't want to miss the opportunity to thank all of you on behalf of my team, Century Financial, myself, and my family, for those people who are connected to who have relatives or friends, or who are working in healthcare industry and the medical industry. Last year has been very tough. This year also we have seen COVID, the second version, spreading a lot. And the people who are into medical industry, healthcare industry, or who have friends or families in medical industry, a big vote of thanks to all of you for risking your lives. Please convey our regards to your friends and families who are into medical industry. This is a testing times for all of us, and I hope that we win this and get through this. Now, talking about risk and emotions in trading, why this particular session was very important for me. Normally, every webinar has investment opportunities in 2021, where to look into. We did those sessions. And also, there was a certain need to understand that why the 2020 year was completely different for investors. It did play a lot with the investors' mind, because same time around, today's 10th March, I think around 22nd or 23rd March is when the market crashed. And a lot of people lost the money. A lot of people entered during that time who made a lot of money by the end of the year. And it was a psychological roller coaster. It was an emotional roller coaster for a lot of investors to think what they should do next. Should they invest? Should they not invest? Are these good companies? Are these bad companies? And there were a lot of biases. There was a lot of psychological and emotional panic which happened among the investors, and that's why it is very important to understand that how our emotions get the best of us when we are trading, and that is something which we have to avoid. So, first part, I'm going to discuss a bit about behavioral finance, where how our emotions they get the best of us when we are when we are into investing and trading, and what we should do to avoid this. So it's a very important first part. Second part, we'll learn about the risk management tools, the risk mitigation tools, how to put a stop loss, what market neutral strategies you can use when the market is moving both upside and downside. I'll show you a very good strategy. Have a notepad. If you don't have a notepad, I would suggest keep this notepad. This next 1 hour is going to be very important for you. So you can note down something. If you have a piece of paper, it will be really nice. Now, we all know that investments and anywhere you invest, it has a lot of risk, and the returns are never guaranteed. Nobody can assure you any kind of returns. So a lot of strategies which I'm going to discuss, a lot of investment insights I'm going to discuss. If you want to invest, first thing you should do is assess your risk, talk to a financial consultant, and only then proceed. Just do not read a random idea and invest without knowing its consequences in terms of risk and rewards, right? Please be very careful. Do not take a loan. Do not borrow money to invest into these markets. These are incredibly risky markets, especially now when volatility is at its peak. Starting with behavioral finance. So friends, behavioral finance, this is the study of the influence of psychology on the behavior of investors. And this can be anyone. This can be you as an investor. This can be me as a financial analyst, as a financial strategist. This can be a certain trader. This can be a very experienced person who has been in the market for 20 years, 30 years. Anyone can be affected by the behavioral finance. And this is something which we have to understand, because this particular area focuses on the fact that investors, they're not always rational. You don't always take a rational decision because your emotions always kick in. Today, and we're going to do a lot of polls, and I would definitely want to know more about what questions you have. So please keep writing the questions on your chat, and as the session progresses, I'll try to answer those questions. Even market-related questions, if you have, I'll try to answer them. Now, when we talk about the rationality of the investors, we always want to make an investment decision which is rational, which is good. But do we always do that? Not necessarily. If this was the case, then we would not be humans, we'll be robots. Because somewhere or the other, the emotions kick in and we end up doing something which we should not have done. And what are these emotions? Now, there are some behavioral biases which have been always in the finance, and this is something which you face every time, and today is the time. So I have one small request from all of you, because I want to make it more interactive. It's not a seminar anymore, it's a webinar. So I want this to be more interactive. Please use your chat option. I will read out all these biases and I'll explain you what these are. Just write the name of the bias if you have been through that, if you have lived that bias, if you have taken an investment decision on the basis of that bias, and you will realize that how common it is. I know it's a bit of an activity, but if you keep listening to me and keep looking at me, you will get bored. So better do something. Let's try to do an activity and see. Now, first, very important bias is overconfidence. Now, we all know what happens in case of overconfidence, as the word suggests. What happens is, this is a kind of tendency where you hold a false or a misleading assessment of your skills. Maybe you have the intellect, you have the talent, but sometimes it might be misleading. It becomes a lot of egoistical belief that you are the center point of everything and you know how market works. Because this is something which can be very, very dangerous. As simple as it sounds, you have to understand that fear is good for markets. Fear fear is good for investing. It kind of keeps you on your toes, and you should have fear in the markets. And this is, again, as I said, what happens is there was a study conducted, there was a survey which was taken among 300 professional fund managers, and they were asked about if they believe themselves above average in their ability. And around 74% of fund managers responded yes. Like they believed that they were above average at investing. Remaining 26%, they thought they were average. So basically, what I'm trying to tell you is nobody thinks that they were below average. Out of 100%, 74% believe they're above average, 26% believe they're average, but nobody thinks they're below average. So this is something, it's a statistical impossibility. I mean, there could be a lot of fund managers who might be below average, but this is something what we hear. And there are a lot of fund managers, there are a lot of hedge fund managers, they would say that, everyone thinks they're above average, but I am above average. So this is something which is overconfidence, and it kind of makes you, make you a lot of mistakes. And this is something which you should avoid. You should definitely have fear from the markets. If you have fear of investing wrong, you will always be on your toes. There could be a lot of different kinds of overconfidence which happens. Talk about overranking, and you guys can write it down if you want to, or this is something which you can always read anywhere. Overranking, for example, when somebody rates their own personal performance as higher than it actually is, and this is something which you always face. Sometimes a lot of people feel that they are better than anyone else, and it's good to have confidence, but overconfidence is something which is different. Again, a different kind of overconfidence when it's called illusion of control. When you think that you have a control over a situation, and in fact you don't have it. And it's a very common thing that when you're investing, when prices are coming down, you think that you got this, you think that you know how to handle this, but you don't. And then in the end, you panic, and that's where the losses starts happening. Then there is timing optimism, which is also kind of overconfidence, because let's take an example of this. A lot of people overestimate how quickly they can do work, and they underestimate how long it takes them to get things done. Because this is, I think, if you talk about the complicated tasks, a lot of business people, they constantly underestimate how long a project will take to complete. Sometimes I would feel that, I can quickly finish this. But the need of that project is you have to spend more and more time. But you feel that you'll be able to finish it faster. So that's your overconfidence. And then again, desirability effect, which is one of the most important ones you should know, something called wishful thinking. And this is where you overestimate the odds of something happening simply because the outcome is desirable. So over here, you have to understand that when we are talking about overconfidence, we have to understand that this is something which happens to all of us, and we have to make sure that we don't fall prey to it, right? The best way to remove overconfidence as a bias from your investing is fear the markets. I don't believe anyone who say that, oh, be daring, don't get scared. Don't get scared of the losses is just one statement, because you should not get scared of the losses, because profit and losses are a part of this whole market. But you have to be calculated. You have to understand before you step into the market. You cannot take a very high risk with overconfidence, thinking that, oh, I'll make this much money from there to there. And please, this is and the new investors, the new traders, they fall prey to this overconfidence, because if they get 3 or 4 trades right, they think they understand how market works. And trust me, people who have been for years and years, market pundits who have seen recessions, they have still not mastered the art of understanding how market works. So there is absolutely no one who can understand that how market works. So please, if you have got 3 or 4 trades right, that's good. Congratulate yourself for a good day, but always be on your toes. Don't try to take higher risks thinking that you know how it works. Second is self-serving. Now, I'm going to tell you this. This is, uh, again, I'm sure I'll explain it to you all this. And if you feel that you have been prey to this, let me know. Self-serving means all the good outcomes which have happened, you take credit for that. But then if you make a loss, you're like, oh, that's just bad luck. So this is something which happens. So most of us, we think of things that we have done and determined that everything is going according to the plan. It's clearly due to our skill. If I haven't made a profit today in gold or Tesla or any other stock, if I made a profit, I'll congratulate myself. Oh, you're amazing. This is what I did. But if I made a loss, then I would just blame it on the markets. And markets are bad, and this is something which is a very hard luck. We should have taken care of this. This is something which is very dangerous because you don't learn. If you always start blaming everything on the markets or on your luck, you will never be able to learn that you made a loss because it was a bad investment decision. And if you don't learn this, then you will keep repeating this particular decision and you will keep making a bigger loss. So please understand, if you want to restrict yourself from self-serving buyers, please take onus and responsibility of your actions. Just don't take credit for the good trades. Take credit for the bad trades. Be accountable for the bad trades also. Don't blame it on a report. Don't blame it on your luck. Don't blame it on the markets. Yes, markets movement happens, losses happen. But then if you have made a bigger loss because you took a higher risk, because you took a decision which could have been bad, could have been right, please take responsibility for both. Not just good trades, but bad trades also. And it is very important to acknowledge this, because what happens is when we have followed faulty reasoning that led to a bad outcome, this is only through admitting and examining our mistakes, and we can learn from those mistakes. It's not a one-shot game. Oh, okay, I lost, I'm out. It's not poker. This is something which is a constant learning process. You make a bad decision, you get back there and take a better decision, right? So self-serving bias means when you take responsibility, you take credit for all the good traits, but the bad traits you think, oh, that was just a bad luck. So if that happens, you will never be able to find out what was your mistake, and you will keep repeating this. So please don't have self-serving bias. Third is hindsight. One of the most interesting things, because hindsight is like a misconception. How many of you always, you always have this thing? I'm sure a lot of you must have gone through this. I've gone through this. This is one of those biases where you say, I always knew. I always knew. Let me give you an example. 2008 financial crisis, .com bubble. Now, if you talk to people, a lot of people like, oh, it was always there. It was always coming. There were so many signs in the housing market. It was always coming. But if you go historically and see, there were the lot of investment professionals, analysts, who were screaming that there was a problem at the time, and nobody listened to them because they just kept buying and buying. People laughed on those investors. So hindsight bias is something where you start thinking, oh, I always knew that. So whenever you make a loss, like, oh, you know what, I always knew it's going to go down. Or whenever you make a profit, oh, I always knew it's going to happen like that. Now, why this is dangerous and why you have to avoid this? See, this is something how you can avoid it. First of all, please always keep a trading journal or a diary with you. See, I always keep a notepad. I always keep saying this whenever I do investment education gigs. Please always keep a trading journal. Always keep your personal diary. That has to be your trading journal. And you have to write down the outcomes of the decisions and the reasons behind those decisions. So if you put a trade, you write the decision, you write the reason why did you bought gold or euro or pound or a certain stock. What was the reason behind it? Even if you made a profit or a loss, you write a reason why I bought this at the first place. This will actually help you, not only avoid hindsight bias, but even it will help you to mitigate against the bias of self-deception. So all these biases, one thing which they do commonly is limit you from learning more or limit you from realizing from your mistakes. So please, this is something you should not let happen. You have to understand that if you limit yourself from learning from your mistakes, you will never be able to grow. So this is how have most important thing to avoid hindsight bias is to have a trading journal, have an investment diary, which will help you understand why you have taken a specific trade, what's the reason behind it. Another is confirmation. Now, confirmation bias is imagine that a person. So just imagine, like let's take an example for confirmation. This is basically uh, how can I say? This is something which when you're looking at an information, for example, let's say a person who holds a belief. If okay, let me take a poll over here. I think that's the best way to do it. Um, let's take a poll right here. It's a very funny question. But there's a poll on your screen right now. I would really appreciate if you can answer this. Which hand you use to write? Like, are you a right-handed person or a left-handed person? Let's understand. What are the what's in this? I have few people. Let's see what are the odds in this. Are you a left-handed person? Do you write with left hand or do you write with the right hand? Okay. To be really surprised to know, I have almost 90% people who are right-handed, 10% left-handed. Great. So most of you are right-handed person. Now let me tell you. Let's say I told you that left-handed people are very creative as compared to the right-handed people. Now, if you find a person who is left-handed and who is creative, this will kind of create a confirmation bias in your hand because you have always heard that left-handed people are creative, and if you meet a person who writes with the left hand and is creative, Amitabh Bachchan is left-handed, Sachin Tendulkar is left-handed. Now when I give you this information, you'll see, oh, left-handed people are really famous, they're very creative. Now this kind of creates a confirmation bias. So confirmation bias is again something when you hold a belief in your mind, and when you encounter that belief, it kind of becomes an evidence, and it continues the belief which you have. So this is again, it's a tendency how you process the information by interpreting the information that is already consistent with a belief. Now, what is the problem with this thing? Why is it a bad thing? Is it a good thing? What is the one problem with this particular bias is it will make you less likely to engage with information which challenge the views, right? Which means even if you are exposed to information which is challenging, which is different, you will reject it completely. You will not be open to any new information because your beliefs are so much supported by a couple of informations you have seen that you have created this confirmation bias in you. I'm getting a lot of people writing about uh, overconfidence and confirmation. Although I thought the very popular bias was hindsight that I always knew, but I see narrative fallacy, I see overconfidence, confirmation. Definitely, we'll talk about narrative fallacy also. Now, so this is something which we can check, and then follows narrative fallacy, which is the fifth one. And again, narrative fallacy is this is also something we are talking about emotions. Narrative fallacy, the first word narrative fallacy in itself, the word means that when you are putting a false picture. People are stories. People love stories. I'm sure anyone who's there right now, there would be no person who doesn't love stories. Everybody likes to hear stories. Even when you're a student in a class, teachers will always give examples by telling stories. Stories is something where we connect to, we get emotional to. And narrative fallacy is exactly the same because it kind of rewires our brain and it we want those stories to be true. So that's why when think about all these stories, think about Elon Musk and Tesla and Elon Musk reaching to a space, great story. Think about buying Apple shares when it was, or buying a Bitcoin when it was $5, and then it went to 50,000 and somebody made millions out of it. It's a good story. But does that make Bitcoin an investable asset, or a conservative asset, or a less riskier asset? It doesn't. A stock or a commodity or a currency might have a great story, but it doesn't mean, it does not makes it a good investable asset. It may not necessarily make it a good investable asset. So where there are no stories, investors might get aside. That's why these days, if Warren Buffett's plan was very simple. You buy a business, you keep it for 20 years and it grows and you make a lot of money out of it. But these days, there are a lot of those companies which you still buy and keep it for 20 years and might make very good money for you. But those companies, they don't have stories. They don't have anything happening. They're not buying Bitcoins, or they're not going to space, or they're not doing anything extra. But these are good companies. But still, you will not look around those companies because they're not in the market. Okay, let me reset poll. Okay, I'll just write one more poll here. Just writing a poll, guys. How many of you know about okay? How many of you know about GameStop? Just put a yes. If you know about it, yes. If you don't know about it, no. Right? 1, 2, 3, 4, 5. Okay. 10, 12. Wait. Okay. 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 There. The change. 15, 18. Okay. 30, 32. Okay. Great. 34. Mhm. So I have currently 66% who say they are aware about GameStop. 33% who are not aware about GameStop. Majority of people, if you know about GameStop, then you also know that it was not a company which was expected to go higher unless the community of Reddit, which they started spreading rumors, talking about it, they bought in bulk, and then basically the stock prices just start inflating at no point of time. It doesn't have a proper fundamental. It belongs to a business which has already passed out. That business is not there anymore. We are talking about gaming, brick mortar style, something which I used to do years ago when I was a kid, something which you might have done when you were a kid. Now, this is something which you have to understand, that when a story comes in, you get inclined to love that story because you want it to be true. So now everybody is buying GameStop stocks because there's a story to it. Everybody said, "Oh, let's buy and do this." So please do not fall for stories. First thing how you can avoid narrative policy, because a lot of you have written narrative policy here. So I think everybody has seen or you have fallen prey to a good story. Uh, Please understand this thing. Anybody who tells you a very good story about anything, the most important part is you have to check the fundamentals. Don't believe on the stories. See what they are doing right now. Look at their discounted cash flows. Look at their intrinsic value, whether it is worth buying it or not. Don't fall for stories. What Coca-Cola did years ago is what was years ago, but what's the position right now? What's the future for that particular company? So that's why the fundamental analysis and earnings and research comes into handy. Now, followed by representation, herd mentality. I will discuss herd mentality very easily. Herd mentality is simple. Uh, you hear a lot of noise in the market: buy Tesla, buy Apple, buy Tesla, buy tech, buy Netflix, buy Zoom. You end up buying it. You don't see anything left, right, or center. You just buy. This is one of those efforts where you kind of become uh, insensitive to market movements. You just follow what others say. And this could be any one of you, by the way. This has been me definitely when I didn't know about stocks enough, when I didn't know about where should I invest into. I would talk to a bunch of 4 or 5 people or 2 or 3 people who would take care of our funds, who would just tell us, oh, you invest, just invest here. It's good. I have heard from someone, this is a very good stock. Heard from someone is a classic herd mentality, because everybody is listening from somewhere and they're putting into it. Don't be a victim of herd mentality. Do your own research. As Warren Buffett rightly said, when people are running in one direction, you should start. When people are walking into a similar direction, you should start running on an opposite one. So please do not fall prey to herd mentality. Just because everybody is doing it, it doesn't mean it's right. Also comes representation. Now, representation bias is a way of how the picture is painted. Now, there are a lot of us, a lot of investors, and I keep saying us because I am a part of the investing community, and I have also been an investor. I'm still an investor, and I've done all these. I've been a part of all these biases, and I've went through it. Not that I've overcame. I'm still falling prey to a lot of this, but I always try hard and hard to avoid these things, because at the end of the day, these are emotions. Lot of us, we frequently make this mistake. We believe that two similar things are very closely correlated than they actually are. And this is something which is a very common error, because we become very confused. Now, let's say I'll give you one example. And this is something which you can always see. If I give you two pieces of information where I tell you that, okay, let's say first important thing, that Tesla is trying to very hard to reach to space. And that's information one. And I also tell you that the EV industry is gaining a momentum. Does that mean Tesla stock is a good stock to buy? Just because I said EV industry is doing really well and Tesla is trying really hard to reach to space, I just connected to relevant information, but to relative information. But these not are closely connected. These are very separate. But because Tesla owns a division of SpaceX which looks into space and research, and Tesla as a company does EV, I said the EV market is going to grow and Tesla is trying really hard. So today, if you have to invest into space exploration, you cannot just do it on the basis of that. These two informations are completely separate. What you have to see is that what Tesla is doing right now. Are they able to fulfill their orders? Are their earning per share increasing or not? This is a very common thing. How you can protect yourself against these kind of representative bias. You have to understand as an investor. As I said, the first important thing, keep an investment diary, because if you don't keep an investment diary, you will never be able to give yourself a logical reason. Always write a reason to why you took this particular trade. And see, in terms of financial markets, I'll give you a very easy example how we face this thing. We always assume that a good company like Apple or Microsoft is always going to do a good investment. This is a very common representation bias because we know Apple is a company which has a lot of cash, but it doesn't mean that Apple, whatever decision they are going to take. One of this example was when Microsoft did a merger with Nokia. I'm not sure how many of you know about this, but Microsoft actually did a merger with Nokia, and it did not go very well for them. So they had to cut it down. They have to get out of that particular acquisition. Sorry, I'm saying merger. I think it was an acquisition. Now, people that time looked Microsoft. Oh, Microsoft is a big company, great company. They never make a decision wrong. So we saw stock prices of Nokia moving. But at the end of the day, it turned out to be a bad investment decision. So they got rid of it. So a lot of people, they fall into representation bias because this is a very common thing that if a company is cash rich, it's good, then it's always going to make a good investment decision. Please, that's not the right thing. There is loss aversion. A lot of people are scared of losses. So whatever decision they take, they can't see losses at all. They're loss averse, which means they don't want losses at all. So what a lot of decisions which they take, they always keep regretting, oh, what happens if I make a loss? And when that happens, their confidence is completely shattered. So be risk averse, but don't be loss averse. Risk averse is good. Risk averse means you are scared to take a high risk, and that's okay. But if you are scared to take a loss, then it clouds your judgment. Don't be scared to take a loss. Loss and profit will happen, what I said at the first place. But be risk averse. Calculate your risk rather than being scared of the loss. Then there is anchoring. Anchoring bias is one of the most important thing, and it kind of is something which we always fall to it. Please keep writing if you have been a victim of any of these biases. I'm getting a lot of names and a lot of people who are writing right now. So anchoring bias, and I'm sure this one is something which everybody must have think. Let's say and I'll give you a direct example. Let's say if I ask you, let me actually ask you why. Okay. Since these polls are really good, let me ask you a question. Your target price for Tesla. 800, 900, 1,000. Okay. Now, the current price of Tesla is 700 today. Now, what do you think the price of Tesla is going to be? The current price is 700. And anybody who feels that 8, 900 or 1,000 is not the right answer, you can send me by chat whatever your target is. Even if it is downside, no problem. The current price is 700, by the way. Current price, once again, is $700. If anyone thinks that it is below 800, write over this chat. We'll take 10 more seconds. Okay, I have literally out of a crowd of 40 people. Okay. So, okay, great. So out of crowd of 40, 45 people, I see 40% said 800, 40% said 900, 20% said 1,000. And I got two individuals chat. One gentleman thinks $350. which is well below. So point taken. Another is 750. And I said the price is 700 right now. So 750 is kind of above the current price. This is exactly what anchoring bias is. I told you the price, that it is 700 right now. So what do you think the target is going to be? 800, 900, 1000, and you selected either one of them. Very few of you said it could be below 700 also. In fact, hardly. I got one answer that says 750, so that's still above 700. I got one answer that says 350, which is below. But most of you selected 800, 900, 1000. Why? Because I told you that the current price is 700. Now, when the current price is 700, you are targeting above 700. And that is what anchoring bias is. I placed an anchor. And this is how sometimes you place an anchor when you're looking at a stock price. Today, if I ask you what is Apple's target price for you, you will see what's the current price today. And then you will put your target. So if you have seen, okay, it's $200, you might see, oh, 250, 260, 270. But it can be on the downside also, you never know. That will be only done when you do a thorough research, right? So you could have said upside, you could have said downside, but you still went for the upside because the anchor is around this much. Now, how anchoring bias works, how you can avoid this, something which is really important, by carefully finding out the intrinsic value of a stock. Because the root of this bias is where you put the price anchor at. Because when you put a price anchor at the current market price, above or down, your targets will be on the basis of that current market price. So to put the anchor at the right place, you have to find out the intrinsic value, or something what we call it as discounted cash flow method, finding the lowest value of that particular company. So this is not something which is which should be a yearly low or a yearly high. Through a discounted cash flow method, you can actually find out the actual value below which a stock cannot go. That is called the intrinsic value. Like, for example, today, if I say gold as a precious metal, can that go zero? No. You will always have this in mind, no, gold cannot go zero. It will always have some value, right? Which could be its mining cost. So that is what the intrinsic value is. It might crash horribly, but there will still be a certain value for which that gold will be worth it. It will not go to zero. That's what it is in the mind. So you have to find that value, and it is easily done. You can always talk to your consultants and experts, and they can provide you. This is something which is available, right? So last but not the least, framing bias. And framing bias is again something how the information is presented to you in terms of fact. Like, for example, whenever a company comes up with the earnings season, when their earnings come out, let's say the earnings of a stock is 2.5 and it was expected to be 2.7. Okay, write this down if you want to, so you will understand better. Let's say any stock number A, the earning was $2.5 for first quarter 2021. $2.5. Expectation from the Wall Street was $2.7. Okay, but Q4 2020, their earning was 2.3. Now, if a company says that we have got $2.5 earning per share this quarter, which is higher than our previous quarter, which previous quarter was 2.3, you will immediately think, oh, that's a good company, their earning per share is growing, you are going to buy it. But if I would tell you in a different way that earning per share is $2.5, where Wall Street expected 2.7, now your views completely changed. That is what framing bias is. This is how, when information is framed in a manner, that which side you get inclined to. And this is something which happens a lot. I'm getting a lot of people writing framing right now. So I'm sure you must have always read about this. How you protect yourself against framing bias. See, the most important thing you can do as an investor is challenge it. challenge the framing. Try to rephrase the information you're reading and see what impact, if there is any impact, see what impact it has on your conclusion. So, like for example, look at a research report, and it can come with a lot of opinions, right? A research, because there are a lot of people who think in a completely different manner, their judgment is different. So, what you have to do is try to be logical, have a very reflective approach to your decision making, and most important thing, don't take any impulsive decisions. Impulsive decisions are, it is never going to be right. Maybe once or twice, if you're lucky, you hit the right spot, but then it's never going to be right. So avoid being impulsive. Getting a lot of people again framing herd mentality. Yeah, I mean, they exist, and it's not just you, it is all of us. We fall prey to this, but you have to take responsibility for that, because if you don't take responsibility for that, I don't know how many people right now must be thinking that, oh, I lost money in the market, but we were just not lucky, because other people must have made money over on the other side of the trade. It's just dumb luck. It's not. I mean, luck exists, that's true. But please take responsibility for the bad investment decision, because what happens then when you accept that you went wrong, you see what your mistake was, and then you start learning from those mistakes. Everybody does it. I have done it. I'm still doing it, and I'm learning from it. And it will be a gradual process. There is no embarrassment, there's no awkwardness, there's no shyness. You took a bad investment decision, you lost money. Okay, no problem. But here you are learning from your mistakes and getting back to the market. That's what is really important is. You can go out and tell everyone, oh, stock market, always lose money, nothing's going to work. But that's not right. I mean, if you have to invest today, where are you going to invest? Fixed deposits with how much interest? Inflation is so high. There are only two asset classes most of the time which gives you a good hedge against inflation. One is stocks, another is real estate. And you cannot be only stressed on one asset class. You cannot be putting all your money into stocks. You cannot be putting all your money into real estate, or you cannot be putting all your money into gold. So that's why we have to start understanding how to manage your risk, which is the next segment. Now, risk management tools, the first and very important thing is stop loss. Now, when we have talked about all these behavioral biases, stop loss, not putting the stop loss is one of the biases which comes in. That when you buy something and you don't put a stop loss because you are so overconfident, you're thinking, oh, this is going to go up. Don't worry about it. This is absolutely has to go up. And if it comes down, then I'm going to buy more of this. Something what we have also seen as a pitfalls of online trading. This is called let us average down. Sometimes what happens whenever any price of asset comes down, people start buying more quantities, and price goes further down, you still buy more, so that the moment it starts going up, you can recover. But you have to understand, if it's going down, try to find out why it's going down. And first and foremost, please calculate your loss, put a stop loss. How to put a stop loss? Very easy. It is available in every platform. And I'll give you a small demonstration of the live market and how to put a stop loss. I hope everybody can see this platform. I'll take example of, let's look at shares. I think a lot of shares these days are trading. Okay, give me a name of the company you would like to see me trading right now. Guys on the chat, write any name of the company you want me to take an example as. There are a lot of sectors, healthcare, pharmaceutical, and I'll take example of all of them. Anyone, anything you like. Almost everything we use is it's a okay. I got Tesla, I got Apple, I got Boeing, I got Netflix. Anyone else also? Been talking a lot about Tesla and Apple. Okay, perfect. See how it frames into your mind. I've been talking about Tesla and Apple now. When I'm asking for suggestions, all I'm getting is Teslas and Apple. Okay, IT. So let's do one thing. Let's take Neo, Palantir, Apple, Teslas, something which has gained some momentum in last few days. Let's take Tesla. Let's search for Tesla. I'm just going to show you what happened yesterday, since yesterday. Uh, Remove all the drawings. This is what Tesla looks like. It was around, I'm increasing the size of the text, everybody can see the price. It was around 566 on 9th of March, which was yesterday, 6:30 p.m. $566. It opened higher to 605, 9th March, and ended at 672. And today it opened at 717, and now it has again at 678. It has gone all the way to 713 and now it's 680, which means yesterday was 566. It went up all the way to 717 and it is now 677. So either it is $100 up in one day, this particular stock. Now, if I buy Tesla right now, how much money? So I'll take Tesla also, and I'll take a few more stocks as well, and I'll equally buy different ones. Let's take NEO. Let's also take Apple. And I'm just going to show you a day's performance of how all these stocks since yesterday have gone up. Okay. So this is NEO. It was $41. It opened today at 45. Today, right now, it has again come to 41. But a day before, it was 35. So from 35, it has gone to 45, $10 up since yesterday till now. Apple, on the other side, if you see, 9th March closed at 116 and then went to 121. And then again, it is 120. So from 116 to 121. Now, what I'm going to do is, I'm going to buy all these stocks, and I'll show you that where you can calculate your risk. Now, I buy. So I have $100,000 in this account. First of all, please leverage. Do not take too much leverage. Market is moving so volatile. Even if you don't take leverage, you get so much movement. So please, currently, I'm taking a very zero leverage trade. I have $100,000. So I'm going to allocate this $100,000 30, 30, 30, 3 times into these stocks. So I write $30,000 in my amount column, which calculates my number of shares for Apple, 250 shares. I click on buy. I bought 250 shares of Apple. Second, I go to NEO. Similarly, $30,000, 700 shares, and I place the order. It's done. Tesla, 683, $30,000, 43 shares. I buy right now. You see how neatly I am putting the amount and it calculates the number of shares for me. It's very easy. Now I go to my account, click on positions to see what I'm doing right now. So all these tech stocks, you can see $200 profit, but avoid the profit bit. What I wanted to show you was, first and foremost, 30, 30, 30. I have all these 3 companies, $90,000 worth shares. You see my account value, 100,000, 120. I started with 100,000. So it will keep moving. It will keep fluctuating. I'm not doing profits and losses here. Now, what you can do, try to understand, if today you have $100,000, then there is something called a 1% rule, which tells you that you should not lose more than 1% of the total value of your trade. That means that whatever trades you took, how many trades you take, but do not allow yourself to lose more than 1% of your account value. So if you have put $100,000, do not allow yourself to lose more than $1,000 in a day. Why? Because it will take, if you do that, you restrict your losses to $1,000, then it will allow, it will take 100 regular trades non-stop to go wrong for your entire $100,000 to get depleted, right? So how you restrict yourself? You have 3 stocks. You want to restrict yourself to $1,000. Click on stop loss. $1,000 divided by say 300. So you put your stop loss at $300. right here. Just write the amount Hello, everyone. So sorry for the glitch. I'm not sure if you can hear me right now. I've just restarted again. Um, if you're here, if you can hear me, please send me a yes or okay. If you can still hear me. Uh, oh, perfect, perfect. I think yes, it will definitely be on my website. There will be a recording which will be on my website. So thank you so much once again for staying. I couldn't be more helpful. This is a network congestion which we always face, and this is I think it's with every software. This is not something which this is one of the most popular softwares which is used. Coming back to what we are talking about, how to manage your risk. So you have a 1% rule where you should not be losing more than 1% of your account value in a day. So whatever intraday trades you do, please make sure that you don't lose. Like I have $100,000, so I don't want to lose more than 1,000 today. It can be less than that, it's up to you, but definitely should not be more. What happens is if you restrict yourself for losing more than 1%, it kind of allows you to trade for a longer period of time. It saves your equity for a longer period of time. Because if you lose 1,000 today, then 1,000 tomorrow, then 1,000 day after, which means it will take 100 days and 100 consistently wrong trades for you to lose all your entire equity. This removes panic. This removes surprises. This gives you much more breather when you have set a stop loss. Now, what I'm going to do right now, putting a stop loss is very easy. If my target is not lose $1,000, then select here, click on stop loss, $300 maximum. So I've made my amount. The price of the loss is calculated right here, which means if I have bought at 42.3, if my price for Neo comes to 41.9, this will get executed even if you are watching it or not. So you modified it. Then again, last, I will put a stop loss here also, $300. If Tesla comes to 677 today, my $300 loss is booked and I'm out of this trade. Close. Now, if you see all my three trades have a stop loss, this will allow me, first of all, to remove my emotions. Because when prices are coming down, if you don't have a stop loss, you will wait. You will not click that button. You will wait. Oh, let it come down. I'll buy it more. Oh, it will go back. Oh, it will go back. It will not. So please put a stop loss whenever you put the trade. This is something, don't be overconfident about your trade that it will always going to go high, right? So this is as simple as that. This is how you can easily put a stop loss and you can do this. So this is something which is the very first rule of risk management. Always keep a stop loss. And since we have taken these three trades, we'll keep them running and see how it goes. Now, after stop loss, second thing is diversification. So many of us, we never diversify. We always get stuck to one instrument. We get married to one instrument actually, because we feel that we know best about this particular market. I've seen a lot of investors, they're very connected to their domestic market, their home country. I have a lot of clients who will say, I only invest into Karachi Stock Exchange. I only invest into Nifty. I always only invest in Bombay Stock Exchange. I only invest into local markets. It is good to be connected to your roots. It is definitely absolutely good to be investing into your home countries, because a lot of these nations are emerging markets and it's very good. But you need to have exposure not only to one sector, but also to different geographies. Tell me, how many of you have iPhones? How many of you have Samsung? How many of you wear Nike, Adidas, Skechers? How many of you eat McDonald's, KFC? How many of you shop from Amazon? How many of you have Microsoft in their system? How many of you travel in a Boeing plane? How many of you have credit card, debit cards which says MasterCard or Visa? How many of you use Unilever products? How many of you back in India would shop from Walmart, right? How many of you have Facebook accounts? How many of you watch Netflix? This is something, this is all global markets. This is all US equities. There is not one thing which is India we are using, or which is Pakistan we are using, or which is Sri Lanka we are using. This is all US stocks. So we are already investing a lot of our money into these products. We are buying them, but then we are not investing into these companies. That is not the right perception. Invest into your domestic countries, that's good, but invest into global markets also. And that includes China, that includes Europe, that includes US, that includes UK, that includes Turkey, that includes so many other equities. Because, and not only just country-wise, you should manage your risk in terms of diversification also. Now, diversification, when you're investing, you should have some money into mutual funds, some money can be into real estate, some money can be into bonds, some money can be into stocks. But obviously, when you said you should have a certain base, please do not invest by taking a loan. Do not borrow money from anyone. I said that in the beginning, that do not borrow money from anyone and try to invest into anything. Investments have risk, and when you borrow money, you are exposed to a debt. Please don't do that. Have a base of an investment pyramid. Have your savings for rainy days, not just for rainy days, rainy years. What did 2020 taught us? 2020 taught us that we should always have an emergency fund, because when the world gets locked down and we don't have no work to do, we still have to feed our families. So we need to have that emergency fund, and that fund is your savings. You have to protect that. That is not something which you play around with. You don't buy bitcoins with that. You don't buy gold with that. You don't invest that into stocks. That is something which you keep it separate. But yes, a part of that saving should be invested, because you want your money also to grow and fight inflation. So you invest. You invest into real estate. You invest into blue chip companies, good stocks. There are so many. The thematic investing is increasing right now. The renewables, green energy, clean energy, futuristic. There are a lot of things which you can look into. So always diversify. Sectoral investing is also one part. Look at this graph, look at this chart. Whenever you see that the economy is accelerating at a good pace and the economy is going high, always look into these sectors. This is really going to help you guys. Click a picture of this chart if you want to. Whenever the economy is growing at a faster pace, start investing into consumer discretionary sector, like the big brands, financials like JP Morgan, Citigroups, industrials, IT companies, companies which are into raw materials and construction, real estate companies. Because the economy is going at a faster pace, a lot of people will have money in their pockets. They would buy branded stuff. A lot of money will be invested into building infrastructure. Financials will get benefited of it, because there will be a lot of loans, a lot of borrowings. IT companies will get benefit. When the growth is moderate, not at the same pace, start taking exposure into communication, telecom basis. When it starts coming down, when the growth slows at a stalled speed, start investing into defensive sector. This is really important, because defensive, energy, healthcare, utilities, this is something which now people might save money, not invest into brands, or not buy brands, but they would still buy essentials. And when you are going through a recession like a pandemic, always invest into consumer staples. These are defensive companies. Whether economy is up or down, you are still drinking a can of Coke. Simple. You drink Coca-Cola, recession or no recession, you invest into defensive sector when there's recession, right? And avoid industrial, avoid real estate, avoid IT during recession. Similarly, when the growth is at a higher pace, more investment into consumer discretionary, more investment to branded stuff, because the economy is growing. So this is something which is really important. Plus, try to understand what your aim is. If you look at a slowing economy and your investment goal is that I don't want something really volatile. I want to reduce my risk. I don't want very volatile. Invest into healthcare and consumer staples. Consumer staples is essential goods, defensive sector, because they are very less volatile and they give you a fixed dividend also. So that is something which is very good, less volatility, fixed income. This is all you need in recession at this point of time. Not at this point of time, basically when there's recession. Opportunistic, if you're thinking that the economy is going to go higher, then you can invest into IT sector, branded stuff, because then these kind of sectors outperform, but then volatility is very high. So you have to take your investment, you have to understand your risk that way, that this is high volatile, but returns can be higher as well. High risk, high reward. When you are looking at, you want to hedge against inflation, you want to make sure that the inflation is expected to go higher, then you want to protect your buying power. So you start investing into real estate, start investing into real estate companies, REITs, those companies which are into construction, those companies which are into energy sector, any company which requires raw material, because raw material is also going to get expensive. So the stock price of those companies are going to go high. So whenever you're expecting high in inflation, look into these particular sectors. Then, last but not least, what I want to discuss, this is the end of my session. So I'm going to discuss with you a very good strategy which I saw, and you can make a note of it. You can talk to your relationship managers after this, and they will explain it to you. Something called pair trading, but I'll give you a better example of this to show you how the pair trading would work. Pair trading is very simple, guys. I'll show you this strategy. Hope everybody can see this. Yes. There is an asset called share basket. Okay. You can invest into individual companies and individual shares, but then you still have a risk. Today, if you want to, if you think entertainment, or let's say vaccinations have rolled in, and you think that the airline industry will get benefit out of this, so you start buying, say, American Airlines. Now, let's say airline industry went up, but American Airlines specifically had a poor balance sheet or something, and the stock started going down. So obviously, your thinking was right, but what happened was, because your risk was on that specific individual company, you lost it. But let's say if you invested into an airline basket where your money is allocated to American Airlines, Lufthansa, Southwest Airlines, United Airlines, then your money is proportionately invested into this. And the value of that basket goes up or down on the basis of the performance of all those four companies. Now your risk is diversified, right? At least you're still invested into that particular sector. So you have a sectoral risk, but individual company risk is diversified. So there is no airline basket on the company, but I'll just give an example. But we do have a couple of share baskets which are related to US banks and gold. And this was a very good strategy which went. You can see the date of this strategy. It was 5th of February. And we started with this strategy because the bond yields started going higher. And rising bond yields was the result of oversupply of bonds due to a lot of stimulus getting in. And we saw bond prices going down, which in turn increased the yields higher. Now, when that happens, the banks are the first sector to get benefited marginally. And when bond yields are high, the financial sector goes up, while gold prices we saw started coming down. So what we did was, there was a strategy which came up that you buy US banks, you short sell the gold basket. Those who don't know about short selling, we can have a one-on-one session later on. Talk to your relationship managers. We'll have a one-on-one session. I'll explain you how short selling works. But currently, let me show you. Short selling means borrowing it from the broker and selling it in the market, expecting prices to fall down. Now, the reason behind this, and see how it turned out to be. This was on 5th of February when we started the strategy. And I'll show you the performance of both the US banks basket. And let's take last 1 month, 5th of February right here. And at the same time, I'll take US gold basket. Remember, you buy a bank basket, you short sell gold basket, US gold. Shares of share baskets, and this is US gold. And I'll take this also last 1 month. 5th February again when the strategy happened. Now, if you see the gold basket from 5th February, right here, it was this particular time, went up and came down almost here, 10% decline. While if you see the bank basket from 5th February, it just went up. So the strategy said very clearly that you buy the bank basket and you short sell the gold basket. Because bond yields were going up, the financials went higher and the gold companies started coming down because gold prices were declining, right? This is something which is called a strategic approach, something what we call as a pair trading strategy. And this is a way how you can protect yourself from volatile markets. And when I say protect yourself, it doesn't mean that there is a guaranteed return on this. Never. Anything which I will say all ever will never have a guaranteed return. It will always have a risk. Please understand this. But we are living in an era where stock prices like companies like GameStop, AMC, these kind of companies which doesn't have any fundamental, they start moving higher because of rumors. So what you have to find out is you have to understand how you can take advantage and be market neutral where the prices go up and down. So by buying one basket and short selling another, not only you protected your portfolio in last 1 month by 20% because banks went up by 10% and golds went down by 10%, so you made 20% on that. Not only you protected your portfolio, you were market neutral to what happens. Pandemic, no pandemic, whatever. Yes, there would have been a risk. If banks would have come down and gold would have gone up, you were in a loss. But because we saw bond yields were going higher, so the logical rationale was to buy the banking stocks and short sell the gold mining companies. And that's what basket allows you to do. So be smart, be careful in what you're investing into. Long-term investment is separate, trading is separate, strategy is separate. Always allocate your portfolio that way, right? Guys, before I finish, I'll take a few questions if you have. It was always wonderful to answer questions. Some of you are asking as well. Can we get a demo account? Absolutely. All you have to do is talk to your relationship managers, and you can get demo accounts also. What do we have to? What do we have to do for a one-on-one session? Just talk to your relationship managers, and we'll definitely have a one-on-one session. We can have it on Zoom, or you want to come to the office, we can have that. So no problem with that. Account opening can be, it's very easy. Just have to submit a couple of documents and this can be done. Why the margin has been reduced as it is not fair? Okay, now this is something very important question. I'm going to take it publicly as well. Why the margin has been reduced? See, margin has been reduced or leverage has been reduced. Margins has been increased. I think it has not been reduced. Sorry. Why margins have been actually increased is the reason that Australian Securities and Investments, which is ASIC, these are regulators and they monitor the CFD brokers. And a lot of CFDs, leverage has been reduced, margin has been increased. Reason, one very important reason, first of all, margin is always in the hands of the broker. But if asset class becomes more riskier, then the brokers itself do not want the clients to take a higher risk. Now, see it this way. Today, if you buy Bitcoin and you block only 5% in such volatility, everybody would be gambling with this. But if the broker says you have to block 50%, then it restricts your position, right? So it's basically for your own benefit. And that's why when an asset becomes more volatile and risky, the broker is in full discretion to increase the margins. And that is something which is legal. I know a lot of people would want to take a high leverage, but then this is to protect you only. can we open jointly with the spouse the account? Yes, you can. You can talk to your relationship manager one or the other way. There are a couple of platforms which you're working with, and you can definitely open a joint account also if you want to do it. Absolutely. Right. So I think please also help me with this. I don't want to stop these webinars, and this is something which is it has always been one of my very significant focus. So more and more reviews coming from you guys on Google. My name is Yogesh. You can always talk about these webinars. If you like the webinar, if you didn't like the webinar, if you have suggestions, feedback, please put review on Google, and I'll definitely work on these. And if you like it, even if you don't like it, please do tell us, give us a feedback. And anyways, we will definitely continue with these sessions. Crypto is okay, but for share basket and indices, it's not fair. See, margins are increasing overall now because, and let me just answer this question as well. Guys, if you have your accounts with brokers which are related to UK and Australia, you will see a margin increase and leverage reduction because years ago in FCA, in UK-based brokers, ESMA, which is European Securities Markets Authority, they already reduced leverage with all UK brokers. For retail clients are those clients who are taken as not professional. To apply and to become a professional client, you have to show a trading history or an amount of $500,000 in your bank statement or worth assets to become a professional client. And this is not a rule which is by one specific company. This is a rule which is done by regulators. So if you want same leverage and reduced margins, apply for a pro status, it will be done. But if you cannot, then to make sure that the retail clients do not take a high leverage, now the brokers in Australia also are being directed and told to increase the leverage. Sorry, reduce the leverage. Yeah, reduce the leverage and increase the margin. So this is not something which is done by one specific company. Every broker under ASIC regulation is doing it. And anyone who's not doing it is not regulated. So we have to follow the regulation. That's the thing. But then see the brighter side. I mean, you get less leverage, you kind of be more protected towards it. So let's have more discussion on this. We'll have one-on-one sessions, please, definitely. So the procedure for the pro trader, you can do it in your own account. Talk to your relationship manager. He can directly guide you towards it, or she can directly guide you towards it. Thank you so much once again, guys. I'm available on calls. I'm available on WhatsApp. You take my number, call me anytime. I'll be available. Once again, thank you so much. Big vote of thanks again to anyone who's into healthcare industry, medical industry, or who have relatives or friends who are into this industry. Pandemic has been very tough. I hope everybody is in good health. You have families and friends, everyone in good health. We'll definitely meet next time with another very informative session, and we'll discuss more and more strategies. Meanwhile, if you want to have one-on-one sessions, please talk to your relationship managers, and we'll definitely meet in one of these days. My name is Yogesh. Please put a good review on Google, or at least give us a feedback, and we'll definitely do one more webinar and we'll discuss more strategies. Please take care of yourself. Stay invested, be away from all the behavioral biases, and let's invest together, and let's spread more and more awareness about the financial risk, the market risk, and how to manage this. Thank you so much once again. My name is Yogesh. We'll meet next week. Till then, be safe.